Welcome back to Lunch at the Market for this Healthcare Monday. We'll take a look at 3 stocks today. The first name is Emergent Group Inc., symbol LZR. This company provides surgical equipment on a fee-for-service basis to hospitals, surgical care centers, and other healthcare providers. The company offers surgical equipment and related technical services support to physicians and operating room personnel in hospitals, surgical care centers, and other health-related facilities on a per-procedure basis, and disposable products and/or ancillary equipment that are needed for a given medical procedure. The company's most recent quarter was fantastic. Revenues were up 10%, and the company set fourth quarter records for EBITDA, which is a fancy accounting term for earnings before interest, taxes, depreciation, and amortization, income before taxes, and net income. Finishing the quarter, they had $7.4 million in cash, or about $1.06. They do actually pay a dividend of about 4.5%. The company has $2 of downside to its 52-week low and $3 to the 52-week high. They do have more cash than debt. In the notes from the quarter, the company noted, "We've continued to be aggressive in providing technician-assisted equipment to our customers and selling the accompanying consumable items that add to our profitability. We are also very much attuned to the current marketplace, in which hospitals and physician groups turn to rentals to conserve cash and control costs, and equipment manufacturers partner with companies such as Emergent to jointly discover new rental opportunities and revenue streams." The fact that they know their market so well means that they should be able to bend and sway with the changing winds of legislation. They're a profitable company, and they're growing the top line, which has been a concern of investors and analysts alike, so take a look at LZR, down over 2% today. Second company we're looking at is our speculative pick from last week, FUQI, which is up over 1% today, and it looks like the stock may have found a bottom at $9.70. The $10 level looks like support now, and we're comfortable telling you to add to your position if you got started with us last week when the stock is near $10. We'll see how long the stock holds down here under 11. We'll all see what the numbers look like when they're released, and they should be released around the end of the month, and that'll give us a better measure of how the company did last year and what we can expect from them going forward. So far, so good on buying that dip, so keep an eye on it under $11. Finally, there was another episode of Undercover Boss on CBS last night, and we were watching. As you know, we're taking a look at all the publicly traded companies highlighted on the show. First, it's a great television, but second, we think that the CEOs, CFOs, and COOs that are willing to subject their company and its processes to this kind of scrutiny have what it takes to change their company beyond the show and into the future, for the better. I'm going to highlight GSIC, which is GSI Commerce. They do logistics for NFL, MLB, Ace, Calvin Klein, Levi's, Echo, Aeropostale, Quicksilver, Timberland, Kenneth Cole, Radio Shack, and more. When someone orders a product from one of these retailers, chances are the people they talk to on the phone to order or when they have a problem is actually a GSI Commerce employee. GSI does the order picking, distributing, and shipping behind the scenes from these companies without you ever knowing that they're part of the supply chain. The company's CEO is under 40, has learned a lot by going undercover recently for the show. The stock is up today. It was a better buy at the open close to $27. But it's actually a great way to play the retail sector as a whole without having to worry about picking out the winners and losers specifically, as GSI does the logistics for so many different companies that you should benefit as retail recovers. This is a bet that we're placing on the management of the company and the market that they're in, because these services are so necessary for retailers to do what they do. They do have good cash flow and more cash than debt on the balance sheet, but their valuations are stretched, so you have to know that management can turn things profitable, especially after seeing the guts of the operations on the show. The stock has a 34% short interest, so you have to know what you're up against, people who think the company will fail. Take a look at this way to play retail through GSIC. Thanks for tuning in today, and we'll see you tomorrow.